All right, we will start. So yeah, I can't emphasize that enough, that real wealth is different for everybody. I've had people come to me, one guy, all he wanted to do was art. He just wanted time to do his art. And I said, well, what do you need to live on? Kind of calculated, and it was about $3,000 a month. And we were able to restructure things so that he could be there, and that was enough for him to have the freedom to do what he wanted. I've also had directors and actors come to me who need to make a minimum of $500,000 a year to feel comfortable. So it's what everybody has their goal, but the most important thing is that you know what that is, what truly makes you happy. I live in Malibu now, and I'm surrounded by some of the wealthiest people in the world, and I can tell you there's not everyone is feeling freedom and happiness, even with lots of money. So money doesn't necessarily have to be the goal. But with that, let's talk about money because it does help, right? It adds to happiness. So I want to talk about, best cash flow markets today and mostly like where we are in the market cycle. Because anybody care about that? Yeah. A lot? Okay. Me too, because I was one of those people that got really wiped out exactly, 10 years ago, right? On Friday was the 10-year anniversary of Lehman Brothers collapse. Anybody, do you remember where you were that day? Do you remember hearing that? Did it affect you? It affected me so closely. A friend of mine was doing all of the renovation for the Ritz in Hawaii. And he had all of his teams, all of his crews. They had already done all the renovation, and he was waiting for his $1 million check. So he had already paid all of his people, all the supplies, everything, and all he needed was that $1 million check from the Ritz, which would seem like something that would come to you, and it was in the mail. And then Lehman Brothers collapsed, and he never got that check. And he kept waiting, and it didn't come, and it never came. And we happened to have an extra guest house, and he lived there for several years while he went from millionaire to nothing and had to rebuild it. So that was somebody else, but we also took our share of loss too. So since then, it's been my passion to not ever go through that again. And I hadn't listened to Bruce Norris yet, unfortunately. Yes, had I listened, I probably would have been in a little bit better shape. So what I want to do is, Bruce tends to focus on local markets, and I do like to look at the global because I believe that that has a tremendous impact these days on where we're headed, and much of it is out of our control, but we still have so much in our control. It's just that you have to know what tide it is. Do I have any surfers in the room? Any surfers? Does it matter if you go out at high tide or low tide? Yes. It matters, right? It matters a lot. If you go whitewater rafting, does it matter if it's spring or fall? Yes. Otherwise, if it's fall, you might be doing a lot of hiking and not whitewater rafting. So it's the same with investing. You just have to know the season. You have to know what season you're in, and your strategy will be different. And do we think we're moving into another season right now? Anybody feel that season happening? I've become a voice on the media for many of the news media to understand what the data means. And today I was on ABC, and they asked about existing home sales, which today was the first day. It was the first time in 3 years that inventory's rising. So that's kind of the story, and something to pay attention to. It's not the end of the world. It's just the tides are changing, and we need to know what that means and what that means for our strategy. So what I wanted to walk through was a SWOT analysis. Anybody do these for your business? SWOT analysis? This is a great thing to do. If you don't do it, do it. And it's so helpful because it just gives you a snapshot. You can do it with your family, with your relationship. Basically, you look at your strengths, your weaknesses, opportunities, and threats. And so let's, okay. You can get the slides. It slides at realwealthnetwork.com. A lot of times people take pictures, so just know you can, if you do that, you get the slides right away. Like I said, the fall of Bear Stearns and then Lehman Brothers just 10 years ago, you can see that drop was really pretty dramatic. So things can change pretty rapidly. And that's the important thing to understand. And a lot of slides that I'll be showing today to show everything seems to be going great until it's not. And what is that thing that changes the tides? I actually have no idea what does it with real tides. I have no idea how it just changes all of a sudden. Anybody know? The moon. Okay, it's the moon. All right, well, I don't know what it is that changes. I do actually have it. So again, Lehman Brothers, you remember all these employees walking out. So what do we have ahead of us? Well, here's some of the strengths. And each slide I'm going to show you has actually a positive and a negative depending on where you are. So the strength, this is the unemployment rate. Look at that, just dropping at new lows. Now, who is this good for and who is this bad for? Who benefits from a low unemployment rate? Workers. Yeah, there's not much competition, so you name your price. Who does that not benefit? Employers. Yeah, so it's not great for employers, all this low unemployment. That is not great for us. And for many of you in the construction world, you feel it because you can't find your workers. It's very confusing messages today because we're hearing all this talk about about creating new jobs, and you know what? We don't have workers for the jobs we have. So it's like, how we're going to fix that? You see what I'm saying? It's a little confusing what's happening above and where that's going to head. So this is either positive or negative. Now, what happens, again, if the employer has to pay more to attract employees because there's not enough of them, what does that do to prices? It's inflation. So again, this is both a positive and a negative slide, depending on who you are. Dow Jones, so here's the stock market, just bam. So who, again, is this good for? These guys, right? People who got in early. Anybody? Yeah? Good for you. Then there's a few $1 million in the room, I'm guessing. All right, this is good for people in the stock market, not so good for those trying to get in. But it's certainly been helpful in fueling the economy because there's lots of capital gain out there. Money flowing. This is home prices. So you can see very not very well, but these lines are the recessions of the past. So you could see down here in the 90s, look at home. This is the Case-Shiller home price index. The peak, the drop, and then we're now above the last peak. This is on a national level. So obviously, there's no such thing as a national housing market, and every market is different. But this is national, just to give an idea of overall, home prices are higher than the last peak. Again, who's that good for? Who is that good for? Higher home prices. Sellers. It's great if you're an owner. Yep. Who's it not good for? Buyers. Yeah. And that's funny because I'm on the news a lot, and I mean today, of course, we all know that news. They want to create a story and they want you to listen, but the headlines are like, housing is struggling. It's like, no. The Fed is raising rates in an effort to slow down inflation. Guess what? It worked, and now everyone's freaking out. It's very strange. Prices are still up from last year. It's just sales have slowed down a bit, and then there's more inventory on the market. But anyway, U.S. GDP is up. So this is good for the economy and jobs. So let's look at weaknesses then. We have lots of strength, but on the other side, a whole lot of debt. And what took us down in the last recession? Debt. It was a different kind of debt. Mortgage debt is not the problem. And that means that for the most part, housing seems to be on really solid ground, right? Most people who got a mortgage in the last 10 years, what kind of interest rates did they have? Like 2%. Did anyone here have a 2%? You do? Yeah.
I did. It was a variable, but it's
okay.
Converted recently.
Sorry to hear that. But a lot of people have low interest rates and are locked in, and that's good. But overall, so in the housing market, the debt is manageable because people aren't necessarily going to walk away from a home because they lost their job and go rent, because it may be that the rent is higher than their mortgage because they locked in such a low rate. So, and again, people had to qualify for these loans. So the housing debt is not the worry today. It's these other things. There's $21 trillion in debt. in national debt. During the Bush administration, we went from $5 to $10 trillion, doubled our debt. Then in the Obama administration, doubled it again from 10 to 20. This is unprecedented. Now we're on a roll doing some more, creating more debt, up 21 trillion now because of tax cuts, because of infrastructure spending. We're gonna continue to see this. Nobody really knows how we're gonna pay this off. So that's just something we have to pay attention to, and we may just ignore it, keep ignoring it, but how long can that happen? That's just something to watch. In addition, the long-term liabilities. So the Social Securities and Medicare and so forth is estimated at over 85 trillion. And who's now, what population is now asking for this? Like the second largest, right? The millennials are the largest, but the baby boomers are the second largest. This massive elephant in the, cobra or whatever, this, massive elephant is now wanting these entitlements. So again, something to pay attention to. Did anyone see the news story that they finally admitted that there's not money in the Social Security bank? Anybody see that? And basically, there hasn't been any, and all that's in there is IOUs anyway. But they finally even said, even those IOUs aren't going to maybe work, because it's kind of like giving myself one. Like, hey, Kathy, I'm going to owe you this money. Oh, guess what? You can't really IOU yourself, but that's what that is. But then an article just came out literally saying, if you're under 50, anyone here under 50? And, I just really want to thank you for paying us because they're not getting it. That's already been stated. It was in the news just last month. So what's going to happen there? And then 2017 net operating loss. This is an interesting thing. Our government, on the government website, is losing $1.2 trillion every year in operating expenses. And yet at the same time, people are buying the debt. So it's kind of like, would you invest in a company that was losing $1 trillion every year? And yet the world is. They're still buying our debt with treasuries and bonds. So, there's just, again, this belief right now that it's okay to have so much debt. We'll figure it out later. Doesn't that sound familiar? Did anyone get an enormous debt 10 years ago? I did. I took on a lot of debt. I was a mortgage broker, so I could just write myself as many loans as I wanted. I took on a lot of debt. I didn't stop to think about what would happen if my plan didn't go like I planned. So everything would have gone great if it went exactly as planned, but it didn't, and we lost millions because of that. And we're seeing that again today. I'm seeing it today in pro formas. Are you looking at pro formas? Have you seen pro formas where the only numbers that are on there are a projected gain in rents and rental increases? What if that doesn't happen? Is it possible that rents will not continue to increase? It's possible. So in your pro formas, there's a voice of experience. Absolutely. Absolutely. So unfortunately, yes, there's a lot of people that are not looking at the what ifs. And that could certainly hurt you if you're looking at multifamily. If rents go down, that affects the NOI, that affects the value of the property, and that's pretty serious. Okay, so corporate debt. Again, people are investing in companies that have never, ever seen a profit, and they think that's become the new norm, without really stopping to say, wow, I wonder how I will get my money back out of this. 76% of IPOs in 2017 were unprofitable. Corporate debt at all-time high. 14% of 100 of the largest U.S. companies have interest expenses higher than their EBITDA. Just interest, along with the U.S. government. And a record $800 billion in corporate buybacks this year, which I got to admit, I don't really even know what that means, except that I think it means that it makes the stock value look higher, and all the profits that we got, that businesses got from the tax cuts, maybe just went to buying their stock back, which has driven prices up. I see heads, so maybe I got that right. Yes?
Why don't you define EBITDA?
It is earnings before Interest, taxes, depreciation, and what? Amortization. Yes. So that's how you basically how you value. That was good. Yep. That was good. I think who did? Was that you guys? All right. There you go. Yeah, I kind of knew someone was going to call me on that. I'm like, I get it. Yeah. It's basically how you value a business. Okay. And then we look at the U.S. population. So we've looked at the government, we've looked at corporations, and then we look at individuals. And you've probably seen the CNBC survey. It wasn't a massive survey. It was maybe a few thousand people, but of the survey, 60% said they had less than $500 saved for emergencies. And additionally, school debt is at all-time highs. Have you kind of seen what kids are able to get on their student loans? Are you anyone experiencing that right now? It's just amazing to me. I don't remember this when I went to college. I don't remember it being so easy to get money. But my daughter has two friends, both from single parents, both with very low income wages, and both kids got full financing to schools that are $50,000 a year. Out of state. So if you're in California, you'd go to Boulder, which, let's face it, it's a great and very expensive party there, but also a great school. These kids walked away with over $200,000 in loans. I mean, that's what they were promised with absolutely no way to pay it back. Can you imagine being a bank and saying, I'm going to give this 18-year-old $200,000 for an education. I'm sure they'll find a way to pay me back.
It's government guaranteed.
It's government guaranteed. Exactly. That's the difference. So debt at all-time highs. Now, how does that affect the housing market, by the way? Because when these kids get out of college, they're just saddled with this debt that affects debt-to-income ratios. These are not things I experienced. I did not get out of college with friends who had that kind of debt. Did you? I mean, I know. So it's amazing. This is going to affect them. They don't even know it. They're too young to even know. Auto debt. What's the next thing someone does when they're young? They usually go get a car. And these days, you can walk in and get a car. Very easy. So same thing. Lots of people saddled with debt, but not necessarily getting, investing that in appreciating assets, unless they're actually getting a degree that they can use. Credit card debt, highest ever. Again, CNBC. So again, this is just $3.8 trillion in consumer debt, something to pay attention to, because remember, it was bad debt that took us down last time, and nobody thought this little subprime issue was going to become a big thing, right? It was just, it's just that, don't worry about it. So, with all of that, let's see, we're talking strengths, weaknesses, opportunities. What do you do with this and how do you make money from it? What's the opportunity with all this information? One of the things that is available to people in this room, a lot of people in this room, is this ability to cash in. Because we live in a place where if you owned property, you've got some money, you've got assets, and we're so lucky. We're so lucky to have that. Back 10 years ago, this chart basically, this shows until 2016. This shows the U.S. median home price, and then this is the U.S. and this is Texas. I think I've got a pointer. Oh, nope, I don't. I don't know what I just did. All right, there might be a pointer in the middle one. Okay. So this is the U.S. home prices. This was Texas. So back in 2004 and 5, you had an amazing opportunity to sell. California prices were way above U.S. So it was like up here. So you had an opportunity in 2005 to sell California property and exchange it for Texas property that had not bubbled. And in doing that, when the markets crashed, you wouldn't have lost any equity and you would have just cash flowed along the way for the most part. So that's kind of an opportunity we have today, is if you think that maybe something could be coming, then you can reposition yourself so that you don't feel it as much. This is exactly what I learned on The Real Wealth Show. That's my podcast. I don't know if I've got any listeners here, but I've got The Real Wealth Show on iTunes, and I started it over 10 years ago. We talked about it at dinner. I started it about 15 years ago in a desperate attempt to understand how all this works. And back then, there were not these meetups. I don't even know if there was a meetup. I don't know if we have that internet capability yet. Yeah, no. So the only way that you could figure this thing out is to go to these real estate events that usually sold boot camps, and you'd buy the boot camp and you'd learn it. So there weren't podcasts, that didn't exist yet. But I had a radio show in San Francisco, and that gave me the ability to interview people that normally would never talk to me. So I took advantage of it. It was wonderful. I took advantage of it, and I got to talk to people like Robert Kiyosaki. And at the time, I was a mortgage broker, totally cashing in on the frenzy of that time. But I remember saying, to him, I think even privately after the interview, like, none of this makes sense. Is this normal? I'm new to this. The short story, which is in my book, is that my husband was diagnosed with melanoma. He was told he would have 6 months to live. We had 2 little kids, a big house. I didn't believe it. The doctor was wrong, and he's healthy today, but I just made it my passion to figure out how to make money, make passive income so that he could get better, so that I could let him, that he could rest, I could take care of the medical bills and the kids and everything in case the doctor was right. So that's how I started the show and started interviewing people, and then I I appreciate that. Thank you so much. Thank you. I say that because I can't believe 15 years later I'm here. I'm standing here. So you can really create anything one step at a time. And that is what I did, one step at a time. And I interviewed people. Tell me how you did it. Tell me how you did it. And that was what he told me. He's like, this is a big fat bubble. The way you know is affordability. That's exactly what Bruce Norris looks at too. Affordability. That is the key metric. And when that is whack, now back then it looked affordable because the way that loans were structured were basically not honest, right? They were liar loans. You could lie your way into it. I was a mortgage broker and saw it all the time. It was the banks that would tell me to do it. If I turned in a loan with a certain amount, the bank would say, oh, the person doesn't qualify, so we change their income. You can do that? And I would say, I'm like, you can do that? He goes, no, you can't do that. I mean, you shouldn't do that, but they'll let you do it, but you shouldn't do that. That's fraud. And it's going to all come, like he could see it coming. It wasn't real affordability. It was fake. And he said, what you want to do is get into the real markets. Texas at the time was not doing those kind of loans. They had gone through the S&L crisis. It had wiped them out. They had gotten wiped out by oil crisis, and they were like, okay, we're not going to have funny loans, and we're not going to be dependent on one industry. And Texas became a very business-friendly place. Jobs moved there, people moved there, but the housing had not caught up. So it was this amazing opportunity to get into a place that was growing so rapidly, but housing hadn't caught up. And he knew that. So I jumped on a plane. Our house in California had gone up from 500,000 to like $1.8 million in 10 years. So we had just made a ton of money in this one house. And after he told me that, I said, okay, I got to jump on a plane. I went to Dallas. I talked to as many brokers as I could. I talked to property managers, and I came back with about 8 properties. And I talked about it on the radio. And then the next thing I knew, I had all these people saying, tell me what you did. I want to do it too. I want your connections. I want, who's your property manager? Who's the broker you used? And this one particular woman came to me and said, I heard you on the radio. I have these 3 homes in Stockton. This was in 2005. Yeah, 2006. It was 2005. She said, all I want to do is quit my job. I hate my job. I want to retire, and I can't. Like, well, let's look at your assets. So she had these 3 Stockton rentals worth about $450 at the time, renting at about $1,200 each, totally in a nasty part of town, constantly being nickeled and dimed with repairs and vacancies. And she's like, I've got these properties, but I don't believe in real estate anymore because I'm not able to retire like I thought I would. I'm like, well, let's take a closer look. What if you sold them? I can show you where I just bought in Texas. They're brand new homes that look like that. You could sell one and buy 3 of those. You're going to be in a really nice neighborhood, A class, with the best schools. And the best part is it was this little town that you had to go around this lake. It's Rockwall, Texas. Anybody been there? It's like this little darling little town with a lake, and you'd have to drive around the lake, kind of around Plano, to get to Dallas. But we knew that a freeway was coming in to connect it, and it would be a 20-minute drive instead of an hour. So we were like, okay, all these things are in place, plus we think there's going to be probably appreciation. So she did it. She sold the 3 homes, but we got her into 9 new homes in this Rockwall area. She quadrupled her cash flow because those $150,000 properties rented for the same as the $400,000 one. So she quadrupled her cash flow, and was happy. She's like came in the office and said, "I retired. I was able to do it. This one simple change in my portfolio, and I was able to give that letter to my boss, who had not been kind to her. It's just that dream. You just give him the letter, done, and all because of this one move. I mean, it took her like 1 month to pull this off. Now, about a year and a half later, the market crashed. What do you think these were worth? Like 75. Stockton was the worst. It absolutely tanked. Whoever bought these wasn't looking at the market cycles, right? Wasn't looking at what was kind of the obvious. It was obvious. If you just stopped and looked at what was happening, you would say something's wrong. But nobody else was saying that. But people had to know, right? You had to know. It didn't make sense. But it was so easy to ignore it. And there's some of those things happening today. Like I said, it just doesn't make sense. But people, it's like normal now. So this person lost everything at the same time that this woman had major gains. She quadrupled her cash flow. And once that freeway went in, Texas did not get hit because of all the job and population growth. Those properties are now worth about 3 times what she paid. And that was the other thing. A lot of people made fun of me for buying in Texas because California was booming. It's like if you owned property in California, you made $100,000 every year. And they're like, you're buying in Texas? Like nothing happens in Texas. Like, I know, it's great. So, so anyway, yes, so that is an example of what, some opportunity you have today is to kind of just look at your assets and say, well, I have a whole lot of money in this property. Is it really worth that? I think there was a burned out house in Northern California that just sold for over $1 million or something. I don't know if you saw that, and that made headline news, but it's like, does that make sense? Maybe, I don't know. But you better be able to ride through the storm if it didn't. All right, so some of the things that are different, I've mentioned some of the things that are the same since the last downturn, but some of the things that are different are that we have a higher population in the U.S. So this was 2008, 304 million. And this chart just goes up to 2016, which is 324 million. So we're like over 20 million, about 25 million more in population. Yes?
So in that example and in your strategy, how do you balance cash flow with appreciation in terms of planning the portfolio?
It's such a great question. I mean, if you want to play it really safe, you go for the cash flow. And that was kind of our thinking back then, is that in all honesty, nobody thought Texas was going to appreciate. That's not why we were doing it. In this case, it was about her quitting her job. So she did not do that for the appreciation. However, knowing that was in the path of progress, that there was this new freeway coming in, and just intrinsically, like looking at that brand new house, it didn't look worth $150,000 from my California eyes. I'm like, how do you even build a house for that? I can't even do my kitchen for that amount, you know? I mean, like, so to me, intrinsically, the value was there. And it just made sense that eventually, you know, the values will go up. But nobody agreed with me, and nobody thought Texas would take off the way it did. But if you do align yourself with areas that have strong job growth, strong population growth, and that is outpacing housing, you'll probably see appreciation. And that's what's happening there. And there's other markets where that's happening. So in my opinion, appreciation would come second. Now, having that outlook, I missed out on some appreciation. I could have bought a whole lot of properties in Oakland or Walnut Creek when they were nothing, you know, but I was chasing cash flow around the country. So, but right now, it's different if you were buying in 2009. It's like, yeah, we're probably going to get some appreciation. It's not so certain now. It's different.
Just a little follow-up to this. When you're saying outpacing, what kind of metrics you comparing to say, okay, the housing market, the houses price is like not there as a quality of living?
Sure. I mean, one of the most important things to look at is permits and housing starts and compared to job growth. So if you look at the days on market, you look at the supply of the current housing that's there, and then if you've seen job growth and permits in line, then you're probably okay. Some markets, this is really important to understand, and if you have a good broker or you are someone who can look this up, there are areas where supply is now outpacing demand. Seattle has overbuilt its multifamily. Yeah, and that's kind of all over now. If you talk to anyone, I went to this. Have you heard of the 5-Star Conference in Dallas? I just got back from that, and I didn't know what it was. I was asked to have to speak there. I didn't know what it was, but it turns out it's REO agents, and to hear the way they talk, they're so excited. Remember I said there's a positive and a negative to anything? They're like, we're going to be back in business soon. That was the entire conference. That foreclosures are upticking, REOs are ticking up. I didn't know what was happening because I didn't know what the conference was. And I realized, oh my gosh, again, no matter which side you're on, there's a positive and a negative, and they are stoked because they haven't been in business for 6 years, right? It's market specific, but I am actually speaking at a group in Northern California that specializes in that. And I don't have any backup to verify this, but they said that many of the loan, what was that? Modifications. Thank you. I'm like, something. The loan modifications are now coming due. And it's kind of back to the same situation where they still can't pay it. So again, that was just their perspective that some of those loan mods are coming due. And then, yeah, so I don't think it's going to be anything massive. It's just ticking up a little. Yeah, so more opportunity. And then one of the things they said, and I'll show you on that slide, remember the slide on jobs? The tip, what he said, the economist at that event, was that the average unemployment rate in the U.S. is 5%. So if it's down at 3.8% or whatever it is right now, that is not the average, which tells you what? We're going to probably end up at the average again at 5, which means there would be job losses. And that could create, foreclosures. Again, I don't think it's anything to panic about if you're set up properly. I'm not sharing these slides to have people like, I'm not going to do this anymore. You just need to know that the way the tides are shifting so that you can surf it properly, right? Because you can make money. Like I showed you earlier, that woman made a lot of money and someone else lost a lot of money. So that's usually what happens. Someone gains and someone loses, and you want to definitely be on the gaining side. So here's some more metrics to just look at right now. Is we do have massive household formation. And this is partly due to the largest generation today coming of age, the millennials, just now age, 23 to 35 or something like that, just getting out of college, Just last year, the job market really recovered, and these kids are able to get out of college and get jobs, and they are. And so they're moving out. So we're seeing household formation. And with that, the fact that builders stopped building and these households have been forming, we have the low inventory, which again has been driving prices up. And how long will that last? We also know that interest rates are going up. And is that a factor? Is that something to be concerned about or not? You know, have you noticed, and do we have flippers in the room? Have you noticed a slowdown at all?
In some parts of the market.
Which part?
The higher end.
Higher end, yeah. Anyone else? Higher end? What about on the lower end? Is there even such a thing? Yeah. Are you finding it? Yeah, I'm sure. I imagine it's selling very quickly if you're.
They're holding on a little bit longer, taking a little bit longer to sell.
Even on the lower end. See, I had not heard that.
About 450, 500. Okay, saying that's lower end.
And it's slowing a little. Interesting.
I had the opposite experience. We just put 2 houses on the market at 470. We got over 50 calls within the first 18 hours. On each one.
Wow.
So 100 calls.
Yeah, what area is that?
Silmar and Covina.
Wow, amazing.
Single family or condo? Single family.
So yeah, some of the things I'm hearing, and well, again, back to that REO conference, they gave me this booth, and people, just agents, REO agents from all around the country came up, and I'm like, oh, what's happening in your market? What's happening in your market? And I was shocked. I had not heard this. The overall thesis and theme was things are slowing down. And there were certain markets where they said it is totally oversupplied. And you're not hearing that on the news. So I was shocked. I mean, Seattle's one, and in the multifamily realm. And we had someone, we do syndications because we have now 40,000 people in our network, and we do a lot of syndications. And someone brought me a Seattle apartment, and I didn't have time to look at it, so we passed on it. And I'm so glad, because I just found out that they're oversaturated. And I've heard the same for Dallas. You just need to make sure you understand supply. And if you're buying multifamily or anything, talk to a good broker and make sure that they understand where the market is really at.
Where are we in California?
What was that?
Where are we in California?
In California, I mean, again, it's a big state. In this particular area, I can tell you, I'm from Northern California. Northern California, like San Francisco, without a doubt, it is so over the affordability level. But it's also the heart of the Silicon Valley, so it just keeps going. Who knows what will happen there? Here, I mean, that is really a Bruce Norris question, and I just read his article today. He is basically looking at the payment, the average payment today, versus what is affordable. And in a lot of these areas, including LA, he thinks there's still room for growth based on current payment. But if interest rates creep up, that will no longer be the case. So that is what you want to pay attention to. And that to me is scary. I would not want to live under the fear that interest rates would have that much effect on my portfolio, which is why I own properties in areas where it wouldn't affect it. That's just so affordable.
See, you mean like rental portfolio?
I have a rental portfolio, yeah. But if you're flipping, yeah, just be aware that as interest rates climb, that could really affect your ability to sell.
Well, interest rates is what kind of put things back in order again.
Yeah.
The quantitative easing,
Yeah.
the largest sovereign banks in the world, just
Yeah. Right?
negative bond rates in, Europe and Japan.
I mean,
That's weird. That's just, I can't wrap my head around that.
I will talk about that in a slide, because to me that is the most important thing we need to be looking at, is what the Fed is doing. And yeah.
Was Bruce talking about affordability for an individual or for a 2-income home household?
It's a good question, and I don't know how Bruce looks at it, but I would assume it would be a dual income. But I think, I'm not sure. But I would say household income, because most people do have someone they're living with. Yeah. But yes, there was another question, I think. I'll look at that though. I just got a newsletter today. Usually when I look at those metrics, I look at one person. Like if I'm looking at Texas property or something, I like to see that the average house is not more than 3 times the average income. So if the average income of the area is $50,000, I would want to see the average home price around $150,000. So and that's never been in balance in California, except 9 years ago. We should have bought everything. But yeah, so here, if the average income is $100,000, you're not going to find a $300,000 house. That's not going to happen. All right, but back to the interest rate slide. We know that interest rates are on the rise, but when you look at this chart, should it really be that terrifying based on history? So this is what concerns me about the volatility of rates, because back in the 80s, rates were as high as 17%. Did anybody get a loan that was super high in the double digits? Anybody here?
I was investing, but I did.
You did?
No, but I have a friend who got a home with 23% interest. Wow.
Every single time I talk, someone has told me something like that 17% was normal, and people were buying. They were buying like crazy in the 80s, even with those double digits. So why are we so scared to get to 5% when that has historically been so low? When my dad kind of helped, when I started understanding real estate, he was so excited to get down to 9%. He was like, we're in the single digits. And he just thought, this was money because he could refi and get all that money back and so forth. So the fact that we're still at historical lows and people are freaking out at tiny interest rates, to me, sounds like volatility. It shouldn't be that scary. In the market that you're in, which is this market, you're very dependent on this slide. If rates go up, it's really going to be hard on this market. Even the tiny change in the tax law, which wasn't that tiny, but who is it affecting? It's affecting this market because the tax deductions and the SALT deductions affect the higher priced markets more. Whereas if I'm in, again, I'm not trying to push other markets, I'm just kind of saying what I do. That is, if I have a $150,000 home in Texas and maybe my mortgage is $500 a month and the rent is $900, there's kind of room there for interest rates to go up. It's so affordable. Whereas in some of these other markets, it really could turn that market rather quickly. All right, so with all of that, do we have buy and hold investors? It sounds like mostly, yeah, we've got some. Locally? What? Okay, out of state? Got some? Okay, all right. And then the rest flippers? People study? Okay. All right, well, I'm going to first talk about the affordable rental market because I do think this is a great opportunity moving forward, given a lot of the things that I said earlier with the people in so much debt. And anyway, but where would you buy a rental that made sense? And this slide, I don't know if you can really see that well, but it's a migration. It's population change and migration in the U.S., migration patterns. And it shows basically, again, I don't think you can see it, but Texas, Florida, a lot of migration going down here. Also, just kind of in some of these states and going north. It's not the exodus out of California that people have been saying, but definitely more migration out. And this is a U-Haul chart. Anybody seen this? Pretty funny. It's pretty funny. You have to understand it's U-Haul, so that's people who are doing it themselves. So it wouldn't be the ultra wealthy. These would be average Americans getting their own U-Haul and moving their stuff. The number one place they're going, Texas. Number 2, Florida. Number 50, California. That tells you something. So if you're really looking for cash flow and you're looking for that Texas market, which Texas prices have gone up. I don't have the slide in front of me, but if you look it up, it's just like, woo! So Dallas, Texas is not necessarily a cash flow market anymore. But these are markets where you can still get cash flow. They're not going to be sexy, but they do cash flow, and that's sexy. But kind of the answer to someone's question in the back is, what about appreciation? I personally don't like just cash flow. I think it's boring. Like, there's people who invest in a little city called Jackson, Mississippi. Anybody invest there? Because I always feel bad when I rip on it. But I know a lot of people that invest there because they get double-digit cash flow. Because the values never go up. You can get a house there for $60,000. It will never be worth more. But you can rent it for like $900 or something like that. So a lot of people like those cash flow markets. I don't, because I am born and raised in California, and I need a little appreciation, okay? I need some. So what I look for are markets that cash flow, but also have that potential for appreciation. And what would that potential be? What are the things I said about Dallas that gave us clues? Job growth, population growth, affordability, and the fourth one is that revitalization. If a city is revitalizing itself, then if there's infrastructure coming in, there's probably a pretty good chance you'll see a pop in value. Some of these cities that people don't know, I mean, they're just not exciting cities unless you go there and you see what's happening. Has anyone been to Cleveland lately? What did you notice there?
Lots of new development.
Tons.
Town especially.
Like what kind?
Kind of trendy, artsy, cool.
Like organic restaurants even. It's crazy. In Ohio, did you go to the medical part?
Yeah, I did, yeah.
Who is that? What'd you see? Yeah, what'd you see in the medical part?
People out there, and there's like the biggest hospital in town, or in the country, right?
Yeah. It's the Cleveland Clinic, and it's this entire downtown. The whole area is just medical, 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 and then all around it is like 6 medical universities, and you could still buy a house for around $120,000. So that is kind of an exciting opportunity to rent a house to a doctor or a nurse, and be able to cash flow. I have a property in Cleveland that I've had for 4 or 5 years, rented to a doctor. I don't know why he's not just buying his own house, but he's renting from me, and he's never been late, and it's a cute little house by the lake. They're revitalizing the whole lakefront to make it really cool, and restaurants all along there. So that's the kind of thing when you find out, like a city like Cleveland that has the worst reputation if you don't know what's happening. It used to be called the mistake on the lake, right? It was, because it caught fire. The lake caught fire because it was so toxic. Literally. That's the story of Cleveland that people remember. And it is totally revitalized now. It's not the same place, but the world doesn't know it. So it's just opportunity. Pittsburgh. Anybody been to Pittsburgh, Pennsylvania lately? No! All right, same thing. Pittsburgh is having massive revitalization. We bought a duplex for, $85,000 after all renovation. And it's right across the street from a new Hollywood studio, because Pittsburgh, Pennsylvania, and Atlanta are second and third to Hollywood in film production. Yeah.
So how do you feel about underfunded pensions? Like Pennsylvania, I like Pennsylvania also.
Yeah.
They've got like this terrible pension situation.
I forgot to put that on my slide.
Are they going to fix it or not? Same thing with Michigan.
Yeah.
And I'm invested in Pennsylvania, so I worry about this kind of stuff.
You should. Yeah, I think we all have to worry about that. And I don't know what we're going to do about that. It could get really ugly, and I don't know when. But there are people who think they're getting a pension and they're not going to. That's the bottom line. Everywhere. Everywhere.
I mean, Michigan's bad. Pennsylvania's questionable.
Illinois is terrible.
Yeah, but they're
Indiana.
markets. I really love them, but I just don't know.
It's going to be a big problem. The pension problem across the board is going to be very severe, unless you're in this room and you're taking care of your own retirement. I mean, that's the bottom line. So, you know, that is the biggest issue I think that we need to be aware of, is that,
So, I mean, how do you underwrite that as far as values, rentability? Does that increase?
but I mean, it's
the
here in
value?
California too. It's the same, we have the same we're totally underfunded here.
But does
So-
it increase the viability of low-income housing, or do you know which one's affected first, or do you have a graphic?
Yeah, I think that, you know, there's three things people need: food, shelter, and clothing, but clothing less, right? So food and shelter, you know, and if the more affordable, the better, given some of the slides I showed earlier. That's why kind of on the opportunity, that we're on to opportunities, affordable housing, because there's going to be a lot of people who are going to need it, even down to mobile home parks. You know, it is, like, look it up. The pensions crisis is massive. And I mean, they keep trying. I mean, in Detroit, they went bankrupt and they still managed to, like, okay, we're not going to touch the pensions. Chicago's been trying to, like, deal with the pension crisis, but if they even try, there's riots in the street. So eventually there's not going to be the money. The US government can keep printing money until it can't, but cities can't. Cities can't print money. So either the government would have to print the money for the cities, but just know that there's a massive crisis coming in that realm, and you can set yourself up so you're not, first of all, relying on a pension that may not be there for you, and that you're providing something that people are going to need, and it will be affordable housing. So, but if you find a solution, I would love to know. Yeah.
I'm just scared because I love all these cities too.
Yeah.
And I'm, like, trying to figure it out.
These are great cities. I mean, I'll be totally honest. I have a last slide. One of the things we're doing is investing out of the country. So, and I don't know, does anyone listen to Peter Schiff? He's really negative. he will ruin your day, but I listen to his podcast every day anyway. And he's right. And he's right. So, I mean, like, one of the things he says is to buy treasuries from countries that are not in debt. So if you have cash and you just want a safe place, or you see there might be some things coming in the U.S., you might want to diversify geographically too. All right, but these are some of the cities that today have high cash flow. And in the last recession, a lot of these areas were not that affected. And that's the nice thing, is, like, if you're buying a $100,000 house and it goes down 10%, it's a lot different than $1 million house that goes down 10%, right? So it's just, I think Pittsburgh went down like 5% in the downturn. So a lot of these areas are kind of bread and butter America, working class, working in factories. I mean, if you're really scared of a recession and some of these things, then you want to be near jobs that do not go anywhere. You know, those are the factory jobs and the good old bread and butter America. You know, we're still going to need our food. We're still going to need our oil. You know, these are the areas that just seem to be recession proof. And real quick, I'll go over one strategy that I have found to be to kind of help you get to at least the first million. The first million. Starting with about 200,000. And a lot of people, this isn't something most people can do, but this is something some people can do, especially with the equity that so many of us have been able to build in California. So if you have around $250,000 that you can access, you can use that to buy 10 of those little homes. Because remember, these little homes, they cost you can get a home in Detroit for 60 grand, all fixed up. So if but if you were shooting for about $100,000 for little working class homes, and you put 20% down, it's 20,000. And once you get past 4, it's 25,000 down. And if you shoot for a $300 cash flow net after all expenses, then, and you still can do that. There's not very many markets, but you can still do it. You could buy 10 homes. And Fannie and Freddie will allow you to finance 10 homes, get a 30-year fixed rate. You're locked in for 30 years at that low payment, at that low interest rate, when we think rents over time will probably increase. But if you take all the cash flow from the 10 homes, that's like $3,000 a month, or, right? Yeah, $300 cash flow. Yes. I don't know why that was hard for me. It would be $36,000 a year, right? Did I get that right? All right. So 36, how quickly would you be able to pay off this first house if you took all the cash flow from all 10 houses and paid off one house? A little over 2 years. So with someone else's money, with these tenants paying you, you can own a house free and clear in 2 years. And then if you've increased your cash flow, you can go do it again, take all the cash flow, pay off the second. And an accelerated payoff like that, you could potentially own all 10 homes in about 12 to 13 years if you can, buy the right homes and keep them rented and keep that $300 a month cash flow. So now you've got $1 million portfolio paid off that's cash flowing probably net about $7,000, $8,000 a month. Now 13 years from now, it might be double that because of inflation. So you might have a $2 million portfolio that's bringing in $14,000 a month, but it'll feel like $1 million and $7,000 today. So just based on inflation. But it is a great hedge against inflation. And again, just one way that people are doing it. Now, some people prefer less cash flow and more growth. And given some of the things that I said earlier with all the migration going to Texas and Florida, these are some markets where you might still get a little upside because so many people are moving to those areas because there's no state income tax. You've got 10,000 people retiring every day. They can cash in and go live pretty comfortably in one of these cities. One of my own employees moved to Florida, sold his Northern California house for like $800,000, bought a beautiful house in Florida for like $300,000, and he's pretty set. Got his kids in a really nice school. So we're seeing a lot of that kind of action happening as these 10,000 people every day are going, oh shoot, I don't have that pension, that I thought I had. So another really great opportunity today is being able to build more supply in certain markets that don't have it. We have been building in Reno. Reno is an area with massive job growth because of Tesla and because Apple moved there and Amazon. They're projected to have 30, we were talking about how do you know where there's supply needed. And they're needing 3,600 new homes every year to keep up with job growth, and they're building about 800. So we're building like 200 homes there, and they're selling like that. So certain markets where builders just stopped building after the recession, but jobs kept growing, the population kept growing, that's a great opportunity, and one that we're doing a lot. There can be big gains. Our investors get a 15% preferred and split of the profit on builds. So this is one of the best deals I'm seeing out there, at least for our network. And then, of course, flipping in the right markets. That goes along with, I'll go back to that. Flipping is the same kind of idea as, bringing on new inventory into areas where it's needed. But you've got to make sure you stay understanding that supply-demand balance of the area you're in, looking at the job growth versus permits. All right. So now that was, let's see, strengths, weaknesses, opportunities, threats. Let's look at the threats real quick. What we had mentioned before was the unemployment rate and how that's positive if you're looking for work, how it's negative if you're hiring. But what does it mean to the economy? And this slide is a little eerie. So these lines are recessions. You can see them there. And oddly, just when unemployment reaches a new low and everybody's like, wow, the economy is booming, their unemployment's so low, something happens. And it all of a sudden goes up and people lose jobs. And then everything gets better, unemployment down again, and bam, it doesn't happen slowly at all. It's just like sudden job losses. Happens again. And so you'll see this one was a little bit more slow. No, that was the growth. Then the job loss. This is the job loss. It's fast and furious. Isn't that weird? So right when this would be low unemployment, right when things seem like chugging along and it's really great, economy's booming, oh my gosh, look at all that job loss. So why? Why is it when things look so good that they can turn so quickly? Any ideas? Because it's not like we've been here before. We've been here like every single decade where everybody is irrationally exuberant. You can't lose. You've been winning for 10 years straight. People are now gurus who've been investing for 3 years. I'm not kidding, right? And it happens every time. So what happens next? Tightening. So when the economy, remember when I said when unemployment gets so low, it's hard for businesses because they can't find employees. So they have to pay more. And when they have to pay more, that drives up, wages, and wages drives up the cost of goods for that business and more inflation. And then we're seeing more inflation now with tariffs. And basically inflation is an enemy. We have to control it. So what the Fed does is what they do, they tighten. They start raising rates. In order to stimulate an economy, they lower rates. And to tighten it, or to slow it down, they raise rates. It's a very simple economic policy that we have to understand because it's amazing to me. I'm not kidding. I'm on TV and radio all the time, and they're like, what's happening? Like, it's the story you just did a minute ago. The Fed is raising rates to slow down the economy and slow down inflation. And guess what? It's working. It's working. The Federal Reserve will get what it wants. And that's what it wants. I think they're raising rates again next week or something. So the whole idea is, okay, we really stimulated the economy, and now, we got to pull it back. That's what they're doing. So they're also simultaneously unwinding the $4.5 trillion balance sheet that, if you recall 10 years ago, I know you recall 10 years ago, housing flatlined, right? How do they jumpstart it? How do we bring this? How do we revive it? And the Fed started buying bonds. So the Federal Reserve started buying its own debt, right? That's weird. By printing money. So it's like me saying, oh my gosh, I can't pay my credit cards. I am just going to open up another credit card to pay off those credit cards. Then anybody ever done that? So I'm just going to create more debt to pay off the debt, And that's what's happened. That's what happened. We're going to buy the bonds, going to keep, when the bonds are being bought, interest rates stay low. It stimulated the housing economy. And now it worked, right? It worked. Oh boy, did it work. It worked so well that now no one can afford housing. So they're backing off. So when you see headlines saying, oh my gosh, existing home sales, like today, existing home sales are down. The U.S. housing market is struggling. It's like, no, it is just readjusting. That's what's happening. But hopefully it doesn't readjust too much. Short-term interest rates will definitely be affected by this, even more than long-term. So credit cards, now remember all that credit card debt? Now people are going to be paying more on that credit card debt. And that's concerning. But to me, in the real estate business, the scariest is short-term real estate debt. So be very cautious of that because it's rising. So if you have I had a balloon payment in 2006 and we couldn't. So we did 2 construction loans in 2006 that ballooned. And I was a mortgage broker, and I thought I got a construction to perm loan, but I didn't read the fine print. So a construction to perm basically means it just automatically turns into a long-term loan. No, the loan I signed in my husband's name was a construction loan that ballooned, and I would have to get a new loan. Now, the house was great, nothing wrong with it. Our credit was fine, no problem. But guess what? The U.S. credit market collapsed, and there were no loans. There were no loans. And here I was, 2 beautiful homes finished. The construction loan was due, and there was no money out there. Went to 10 different banks. That's when you turn the keys over. But you know what? It was in Tennessee, and they put you in jail if you don't pay your debt. So you don't mess around with this stuff. Literally, they will put you in jail for not paying your debt. Well, anyway, that's what we were told. So we had to find a way out of that one. So anyway, the short-term debt is something to be very concerned about. Be careful about balloon notes. If you're doing a short-term 3-month flip or something like that, usually housing doesn't move that quickly. But what I'm talking about is some of these multifamily loans where people are so certain, they're taking on projects where the loan balloons in 3 years. What if interest rates are higher? What are you going to do?
What if there's a recession and interest rates are higher?
What if your rents have gone down, your loan debt, your mortgage debt, or what am I trying to say? Your debt obligations have gone up, so now your NOI is down, and you have to come up with more money to get that loan because now the value is low. This is a problem for some people who are the gurus of 3 years in the business. There's a lot of them out there that are saying, you can't go wrong. Well, no, you can. And you need to make sure your pro forma shows all sorts of scenarios in it. There was a,
I have a question.
yeah.
In your last chart that you showed the relationship between jobs and a spike in
Yeah.
the recession. And I'm curious about why it would rise so quickly. I mean, we have had, increases in interest rates
Yeah.
gradually. So
Yeah.
why would it not?
Well, that's what the Fed wants to do, is be gradual. But as you can see historically, it's never worked. So, they're trying to do it without causing too much ruckus. But generally, what happens in this phase is people are so confident. So companies are hiring, and they're spending tons of money on retreats, and kids are going to concerts and paying $600 for a festival. There's just so much confidence, so there's a little bit of overhiring, and then it's like, got to lay off.
There was a
Story,
I think it was
okay.
on NPR last week, and they were talking about, they kind of said the Fed's big problem is they can't really figure out why it happens like that almost. I mean, if they did, they wouldn't have those huge spikes in unemployment.
Yeah.
Do what they're doing.
My thought is that if you look closely, you can read a really great book. It's called The Creature from Jekyll Island. Anybody seen that? Read that? The Creature from Jekyll Island. It'll explain who the Federal Reserve is. And who's behind it. It is the largest banks. So it is not federal, and there's no reserves. It's just the banking system protecting the banking system. So the banking system, the U.S. government, by Constitution, cannot print money. So the central banks can. They got away with what the forefathers thought would be a way to protect us, is don't let politicians print money. So instead, they created a central bank that can do that and lend it, because the government can borrow. So the central banks can just create money out of thin air and lend it to us, and we pay them for the interest on something they create out of nothing. But so part of it is that they've made these loans, and anyway, I could get really political. Read Creature from Jekyll Island. Notice that President Trump is not happy about it. He's been fighting with the Federal Reserve, because he's like, why are you doing this to me? I'm trying to stimulate the economy, and you're trying to tighten. I'm trying to create jobs, and you're trying to take them away. So if you look at that, that's been the argument in the last month. They're not, Anyway, so this, just to show you, is the money supply, to give you an idea of something. This is a test. This has never been done before. All of this crazy growth, all the stock market, and a lot of like really religious Trump fans believe that it's his policy that's created so much growth. But it may have something to do with this as well. If I gave you $4 trillion, please tell me you'd do something with it. Tell me you'd get at least a 3% GDP. Oh, wait, we got that. We're struggling to get that. This is a enormous amount of money that was printed and thrown into the economy. And now they're pulling some of it back out. At least trying. So follow the flow, enjoy the ride, beware the bumps, don't end up like that. Don't sell everything. Protect yourself. And I don't have much time left, but I want to just tell you some of the ways that we are still playing the game 100%, but being protective. Like 1 foot on the gas, 1 foot on the brake. We bought this land. Like I said, we're buying in Reno. We bought this land from somebody. Guess why they were distressed? Debt. Some people bought this really great land in Reno and then got a hard money loan on it. The entitlements took longer. The loan was due. We came in, got a great deal. So we bought this land for a very, very good price. We finished the entitlements, and then we're able to sell these lots for the same price that we paid for the whole thing. So these lots we own free and clear, and we also raised enough money in our syndication to build out each phase. So we build a phase, we use the cash to build the next phase, so 0 debt. That's how you can still play and not lose. So just one example of how to be careful. And these are what the homes look like. They're gorgeous, and that's our builder, Fred. Another one, like I said, we're diversifying geographically, and we also got a great deal on 800 acres in Costa Rica, and the fastest growing city there. We are doing all kinds of things to make that work. We planted 10,000 trees, and we have like an organic farm exporting food. And then we also started this glamping thing. We put these tents, and it's like this whole glamping retreat thing, and people are coming and renting it. So we have cash flow on the land while we build the homes. We're raising money to build the homes, so there's not debt there. And it's out of the country, so there's some diversification there. So again, just another way to have a lot of strategy, a lot of exit strategy. That's what you want. You don't want one. You don't want one exit strategy that's based on everything going perfectly. That's the key. All right, so that's how you find me. Thanks.